So now this part is something that gets people really confused, and I'm going to try to make this really clear. Debits and credits, right? They're the most basic terms to become familiar with, but they just mean, raising one account and lowering another. They represent a fundamental concept of it, and they're the fundamental parts of double entry bookkeeping. But it takes some time to get used to, and don't worry about if you don't get it right away. It takes some time. But let's talk about that now. So in balance sheet accounts, you have a balance sheet, right? And in a way, debits and credits, the T accounts are kind of like a mini of the balance sheet, right? Yeah, on both sides. So asset accounts, and I'll send you a cheat sheet. I got this cheat sheet of what increases what and stuff like that, so you can always learn. But it's not that difficult. If you just get one right, then you know the other side's the opposite, and then it really makes sense. If you can just remember, I would say try to remember that debits increase asset accounts, and credits decrease an asset account, right? So asset accounts usually keep a debit balance, right? You want to have a positive cash, money in the bank, right? So it would be a debit balance, and all of your assets will have a debit balance. Now, when you think about like a piece of equipment, right? You might have, say, you have a truck, and the truck costs 10 grand. Well, that's a debit balance, right, of $10,000. You have an asset of $10,000. But then you take, say, $2,000 worth of depreciation. Depreciation then is what? It's kind of a credit balance account. It's called a contra account because it's a contra to the, you're netting that out to make 8 grand, right? So these are asset accounts that have credit balances, so they're called contra accounts. Kind of make sense?
Yeah, been a while.
But all of these are going to have debit balances, and so when you reduce cash, say if you pay a bill and you reduce cash, what would that do to cash? Would that credit cash or debit cash?
Debit.
If you're taking cash out, you pay a bill. You pay $800 to your landlord.
Oh, debit increases. It's an asset still, right? Your cash.
Right. So you would credit whatever that thing would be. Credit $800. Credit cash $800, right? Mm-hmm. And debit whatever account, on this side.
What's on the other side? So you have a credit of $800. What's on the other side of your account?
A debit.
Of $800?
Say that it was an accounts payable, right? It was in AP. Okay. It was accounts payable. You had to pay. Somebody came and painted your place, and it cost $800. And you put the bill into accounts payable, and now you're going to pay it, right? You're going to pay the bill. You're going to You're going to credit cash $800, and you're going to debit that account $800.
Okay.
And so that's the other thing now on the liability side, right? On the liability side, liability accounts have usually credit balances. They have the opposite, right? So debiting a liability account reduces the liability account, where debiting an asset account increases that account.
Yeah.
So it would be like credit $800 cash, debit Joe's painting and supplies or whatever it is, and that would be one of your vendors' accounts. Right. So you have to have one on both sides of that. And it could be two. You could get into more accounts. Say that the painter did it, but you bought the paint and you paid him $600, and then it was $200 from the paint store. You would credit cash $800 and debit Joe's Paint $600, and whatever paint store $200, and the $200 and the $600 equal debits of $800. Don't worry about this too much, but see how here you got credit balances increase on this side, and the same thing for equity. Equity would be increased by credits. Same thing. Here's the liability accounts, and your equity accounts too will usually have credit balances, and these all have debit balances. So when you reduce these guys, you're reducing them by crediting assets. You reduce liabilities and equity by debiting them. So because the income statement is kind of buried on this side of the balance sheet, it works the same way, right? Revenue accounts, right? Revenues are sales, right? Money coming in. What's that going to have? That's going to have a credit balance, right? Credit increases revenue. And expenses are going to what? Expenses are going to have, they're taken away, so they're going to be debits are going to increase expenses. So just like this one, we debited, this was kind of an expense, right? This $800 in painting fees was a debit because it reduced that side. It was an expense. So this is kind of the cheat sheet here. I'll send you this too, this slide deck.
I think it only can help when you're thinking of like what account it pertains to, because otherwise.
Well, but then you can start to think. You know, you can say, okay, whatever the account is it an asset account?
Right.
Is it a liability account?
Right.
And those are pretty much the two you're going to use. And then, is it a revenue account or is it an expense account?
Right.
Those two are, you know, sub accounts of the liability side.
Right.
So any of your expense accounts are going to have a debit balance, pretty much, right? As you increase them, and your revenue, when that comes in, you're going to make credits on that side.
Yeah, when does it go?
What would you do? Say if you got revenue. Say if you got $500 in a sale, and it was cash, right? What would you do? You'd credit $500 revenue, and you debit cash $500, right?
When do you get a debit on revenue? Like, give me an example if you can.
Maybe bad accounts receivable or something, or you probably wouldn't. You don't get too many, or maybe returns. Returns might be a debit to revenue.
Okay.
If somebody returns something, you got to give them the money back.
Yeah. So let's say it's $10. So you go $10 on your left, and then you put $10 on expense. You credit that back because you have to take it back out of it.
Well, where would you credit it though?
Back into your assets. Yep.
Cash.
That's right.
Right. You debit this and reduce revenue by $10, and then you credit cash by $10 because you're reducing cash because your cash account's going down by $10. If it was a deadbeat accounts receivable, you'd debit revenue and then you'd credit accounts receivable that they didn't pay.
Okay.
So you'd reduce your accounts receivable.
I think it was a write-off from the expense.
Right. Yeah. It's like, they took off for Sao Paulo and didn't pay the bill.
Yeah.
Rack it up.
Right. So you can think about, you'll know any account if you just think about it this way. Is it an asset account, or is it a revenue account, or is it an expense account, or is it a liability, Like, is it an accounts payable, Those are the biggest usual liabilities that you have with accounts payable. Ones where you got in the invoice and you have to pay X amount to whatever. You put that in as a transaction. It goes to accounts payable and whatever the other account is for that account payable. And then when you actually pay it, you take it out of accounts payable and out of cash. So it's an easy way to think about your chart of accounts should be broken up by asset accounts, liability accounts, revenue accounts, expense accounts. And usually you give them each like a 100 series number, right? All your asset accounts starts with 100, and all your liability accounts start with 200, or something like that.
Mm-hmm.
So.
It can be weird. I always think, because I see it all, kind of.
Mm-hmm.
And so when you do the accounts receivable, the accounts payable, but a lot of these companies that we do work for, and there's one person in accounts payable, and then it's got to go through.
Right. They got a receivables person.
4 or 5 other people before that check can
Gets a check.
check. So so I can get something in and it's out the same day.
Right.
It's just so interesting because I think that would almost create more of that stuck in the forest.
Well, absolutely.
That's
If you're an accounts receivable bookkeeper or something like that, you don't know what's going on in the other accounts. You have no clue. Yeah, and I think that would be a really good thing for any large accounting, department, is to train everybody on just so they know what other people are doing, In case somebody gets sick, you can take over and do the other stuff, or at least understand where you fit in the grander scheme of things. Yeah, because people get so siloed and far other trees. Yeah.
Well, you just named exactly how we cut checks. What she just said is exactly how we do it. It's one accounts payable person, and then there's 5 people on a PR. So if you want to cut
all these
anything
approvals,
over
yeah.
$2,500, it's like 5 people.
Yeah.
And it goes through different departments, and then like the guy that's running, the lead guy finally signs off on it.
Right.
And then you get your check.
Right.
And-
It's just.
And part of it, that not just to make it Byzantine and inefficient, but fraud controls too, that it's just not one person. Because
Yeah.
when you have one person that's actually doing it all,
That's true.
opening the mail, saying where the accounts are going to
Well, you
go,
can send
cutting
out
the
the
checks, it makes
Open up
for,
your own account.
there's no separation of duties, and so it's more potential for fraud.
What's interesting what you said is the numbers, because we have those numbers. I'm going to start paying attention to those because we did like control budget numbers, 107 this. I think 402 is our asset numbers for fixed assets.
So you would know maybe
So it
the
rings
400 series might be something, and
Yeah.
300 series is something else. So yeah, and if you get the chart of accounts, then you could know, these are all in that
I
kind
just
of
said
order.
their numbers, but you're right, they lead to accounts. It's
Yeah,
interesting.
and usually they, if you're a bigger company, you might have 4-digit numbers instead of 3-digit numbers because you might have more than 1,000
We got-
asset accounts.
we
You
got
know,
big ones.
Yeah.
Or big banks.
right. So you might have 5 or 6-digit numbers, something like that, or it may not be numbers, might be something else. But yeah.
Cool, I'll look for that.
But yeah, if you look at the chart of accounts, you'll see they usually have some sort of they're grouped in this way because you're not going to have one liability over here in another account. Somewhere. All the liabilities will be sort of sequenced. All the assets will be sequenced, and they might be out of sequence a little bit because you had a chart of accounts that now we don't do business with these people anymore, or that asset went away, or something like that, and so that there'll be some leaps in the numbers maybe, but for the most part, it should be pretty sequential.